This is one of two short videos introducing you to Advocates Wealth Planning's investment philosophy and how we manage our client portfolios. Markets and investing are undoubtedly the most talked about components of your financial life. Though important, it's one of 6 areas of your financial life that we'll address and coordinate to help you live the future you want. But investing is notoriously difficult and causes a lot of stress and speculation. So let's take a few moments to talk about the problem with investing and our solution to it. The problem is that investors tend to inadvertently hurt themselves while trying to either protect their money or time the market to trigger exceptional growth. Here's 3 common ways that happens. Everyone has emotions when it comes to their money. Having them is not the problem, it's how you react to them that counts. Almost every emotion and every mental shortcut we need to survive and thrive as people ends up cutting us off at the knees as investors. We don't have time to go over all of them, but we'll touch on a few of them here. Investors often don't do what they should. We understand why. That's your hard work out there, and the need to protect it is strong. But often, reacting hurts more than it helps. Case in point, the average U.S. equity fund investor earned a little over 8% over the last 30 years compared to 10.15% for the S&P 500 index. The difference is that the index can't react. It stays invested while the average investor adds and pulls money as the market ebbs and flows. Investors cannot sit tight. And while 2.14% annualized difference might not sound like much at face value, the results after 30 years are staggering. The investor who put $100,000 to work 30 years ago ends up with just over $1 million, but they could have ended up with $1.8 million. That is an $800,000 behavior gap. Inverted optimism is another way investors inadvertently harm themselves. Investors' natural reaction is to move with the market, executing trades in response to dips and peaks, and that usually looks something like this. When markets are up, investors feel euphoric, like they can't lose, and they buy more stocks at peak pricing. As the market corrects, feelings of denial begin. You might, at the start of the dip, feel relatively confident that you'll be unaffected by market swings. But near the bottom, it's panic. The media goes nuts, you hear horror stories from friends and relatives, and you decide to sell at a very inopportune moment. As it turns out, investor euphoria, the peak of the market, was the point of maximum risk, and the low, the point of maximum opportunity. It's a simple explanation to buy low and sell high, but markets move with the collective force of human emotion, and it's a rare individual who can stomach the ride in real time. Last, we also tend to buy only what we know. The advice to diversify our assets is as old as the hills. I'm sure it was our grandparents' grandparents who warned us not to put all our eggs in one basket. So why do we keep doing this with our portfolios? Let's take a look at this example. This empty circle represents the global market, all stock from all countries around the world. And the gray is the amount of stock the average U.S. investor has that's invested in U.S. stocks. The orange is the allocation of U.S. stock you should own if you're buying in proportion to the global market. The point is that Americans overbuy American stocks, losing out on other global opportunities and creating a concentration risk. The average investor who lives in the U.S. has 81% of their money invested in the U.S., when the U.S. stock market just makes up over half the global market share. And we are not alone. Let's take a look at the UK. UK investors have 63% allocated to UK stocks, which make up only 5% of the global market. It's 12 times more than they should have. And the biggest offender around is Australia. Aussies love Aussie stocks. They own 80% in domestic stocks that comprise only 2% of the global market. The point is that people tend to buy what they understand, and that creates a bias toward investing in your home country that might not be to your real benefit. Diversification among asset classes is the best way to ensure your metaphorical eggs are protected. And that's the problem. Bottom line, people can't stop being people, and that means emotions, reactions, and biases will continue to impact the market and your portfolio. The good news is we can combat these influences with one simple word: discipline. And the next video will demonstrate exactly how we do that. Thanks for watching.